Insurance contracts are based on the principles of utmost good faith. In a contract of utmost good faith, each party has a duty to reveal information that would likely influence the other party's decision to either enter into or decline the contract. And if any such data is not disclosed, the other party will usually have the right to void the agreement. The policyholder or the insured is expected to disclose the status of his health, family, medical history, income, occupation, or about the subject matter insured truthfully without concealing any material fact to enable the underwriter to assess the risk properly. In case it is established by the insurer that the insured did not truthfully disclose any fact in the proposal form which had a material impact on the decision of the underwriter, the insurer has a right to cancel the contract. The principle of utmost good faith imposes on the parties a duty to act in good faith in their mutual dealings. This principle applies both before a contract is concluded, that is to say, the pre-formation period, and during the performance of the contract, that is to say, the post-formation period. In the pre-formation period, the principle of utmost good faith creates well-established duties owed by the insured to disclose material facts and to refrain from making any untrue statements when negotiating the insurance contract. If the insured seeks a variation to or renewal of the insurance contract, then he again becomes subject to similar duties because here a new agreement is being negotiated. Consider an individual seeking life insurance coverage. He or she would routinely be required to complete an application on which the applicant's sex and age would be requested. The accuracy of this information is necessary for the insurer to correctly ascertain its risk and determine the policy premium. If the applicant gives these responses incorrectly, they could, they could be used by the insurance company as grounds of misrepresentation and breach of utmost good faith for voiding the policy. On the other hand, during the post-formation period, the duty continues to affect the insurance, but the content and effect of the duty are flexible and vary depending upon the circumstances. For instance, when a term of the insurance requires the insured to provide the insurer with information in particular circumstances. For example, at the time of execution of an insurance contract, the insured was a non-smoker, and there was a clause in the insurance policy that the insured must inform the insurer in case the insured subsequently becomes a smoker. Here, the insured is under an obligation to disclose to the insurer the fact of his becoming a smoker throughout the performance of the insurance contract. Another example is when an insurer exercises his right to conduct his insured's defense to a claim by a third party. The insured in question must in such cases act in good faith and must disclose all facts and information to the insurer which might help the insurer to conduct the defense properly. The insured must exercise good faith while making an insurance claim. It means the insured must refrain from dishonesty in the presentation of a claim. And any fraud in the making of a claim entitles the insurer to avoid the insurance. Although the primary duty of the insurer is to make a payment if the insured event happens, the duty of utmost good faith and the duty of disclosure are also applicable to the insurer. This is because, due to the nature of an insurance agreement, each party needs and is legally entitled to rely upon the presentations and declarations of the other. Each party must have a reasonable expectation that the other party is not attempting to defraud, mislead, or conceal information and is indeed conducting themselves in good faith. The general principles upon which the duty of disclosure is based were stated by Lord Mansfield in the well-known leading case of Carter versus Boehm. This is an old case decided back in 1766. This case concerned action on an insurance policy for the benefit of George Carter, the governor of Fort Marlborough in the island of Sumatra in the East Indies. The insurance was taken against the risk of the fort being attacked by a foreign enemy, here the French. It was subsequently alleged by the underwriters that the weakness of the fort and the likelihood of its being attacked by the French were material facts known to the insured, which ought to have been disclosed to the underwriters. This defense failed, but Lord Mansfield took the occasion to explain the principles necessitating a duty of disclosure in these words. Insurance is a contract of speculation. The special facts upon which the contingent chance is to be computed lie most commonly in the knowledge of the assured only. The underwriter trusts to his representation and proceeds upon confidence that he does not keep back any circumstance in his knowledge to mislead the underwriter into a belief that the circumstances does not exist. The keeping back such circumstance is a leading fraud, and therefore the policy is void. Although the suppression should happen through mistake without any fraudulent intention, yet still the underwriter is deceived and the policy is void because the risk run is really different from the risk understood.